questions and they come up as we go through Junior's presentation, then please type them in the chat and we'll deal with as many of them as is possible at the end. Thank you very much for joining us, and I'll hand straight over to Junior. Thanks, Junior.
Thank you, Sorrel. Good morning, everyone. My name is Junior Yoon, and today I'm going to do a quick walkthrough the Redefine Properties Company update. So on our executive summary, we maintain a buy recommendation with an intrinsic value of R5.49 with an upside of 14%. Our outlook remains constructive, underpinned by current fallen bond yields and the recent SARB rate cuts. Also improved fundamentals in the retail and industrial segments, driving occupancy and rental momentum. What would change our minds regarding this deterioration in the property fundamentals, especially further weakening occupancy trends, negative rental reversions, especially further in the office sectors. So just a quick highlight on their interim results. Redefine reported a profit before tax of 1.6 billion, up 47%. Contractual rental income also rose by 4.7%. And distributable income increased by 3.6% to 1.77 billion. Something that is a bit of concerning that we note is their renewal reversions and occupancy vacancy rate in their office segment remains quite high, but it is slightly outweighed by the improvement in the industrial sector and their low vacancy rate in the industrial segment. With this chart, the following chart indicates directional relationship between Redefine and the 10-year bond yields, which indicates that there is still room for a valuation uplift in the multiple given its relationship with the yield levels. The performance of Redefine over the year, Redefine has recently performed in line with the sector. It remains ahead of the ALSI and has lately traded above both of them. With regards to this, our view remains unchanged. Bond yields have dropped further and we maintain a positive outlook, expecting further compression driven by interest rate cuts as seen on the 31st July rate cuts by the SARB. Yields have reverted closer to the 10-year average. While rate cuts may push them lower, we see limited upside in the bull case and have adjusted our scenario weightings to reflect a more probable outcome. The key aspect of our valuation is that we haven't changed our view with an intrinsic value of R5.49. However, we have considered some downside risk highlighted previously by higher office vacancy rates and weaker reversion rates, and this can be seen by Redefine's recent sale of their Rosebank corner office block as it attempts to exit its strategy, exiting underperforming assets and cut debt levels. However, the sale remains in line with the industry, as we have seen some office block sales as well from Growth Point and Emira as well. And now I'll hand over to Sean to do a technical analysis for us.
Good morning, everybody, from a nice cold Joburg. You can see the chart there of Redefine. It is bullish in the medium and long term, trading above its moving averages. In the short term, you can see the share price has been testing that support trend line, but I see today that it is actually broken down below it. So it is triggering a bit of a change in trend. So we could expect a pullback more to that 470. So here we go. Okay. We could expect a pullback to retest that previous resistance around about the 472 level. And if that doesn't hold, we could see maybe slightly bit lower to about 457. As I say, it's around about a percentage down today. You can see also at the bottom here the MACD indicator. It is trading in overbought territory, and it's below its trigger line, so that does confirm the bearish price action. But saying that, on the upside, as Junior said, now the share price is trading far below its intrinsic value of 549, and it's giving we give it a buy recommendation, but I also think it might come into better buying opportunities a bit later, a bit lower. That's how I see it. Thank you.
Yeah, thank you, Sean. Yeah, that's almost consolidation towards the right-hand side of the chart. You know, if it breaks that red trend line going up like that, it should pull back to at least the previous resistance levels and so on. So probably down to about 455 around there in the swings and roundabouts. And then you can definitely take a nibble because, as Junior said, there is a bit of value in the stock. That is our take on it. Let's have a quick look at the chat and see if there are any questions there. I don't see any questions. Let's give the guys a chance to type their questions in there if they have any questions. In the meantime, Junior, so am I understanding it correctly that these guys are obviously heavily geared and in debt around these properties that they hold, and as soon as rates come down, then obviously they become more profitable? That's why the relationship between the bond yields and the rates is so closely correlated to their share price movement.
Hi, Sorrel. Yes, absolutely right. Right on that one.
Okay. All right. Then Richard says, what is the dividend yield on a stock like Redefine?
I think our latest view was around, I think, 9.6% last I checked. So, yeah.
So it's high yielding. They've got, I saw there, I was quite surprised to see that, because I remember when we did this in COVID, I mean, we looked at occupancy rates that were fairly low. But I mean, you're showing occupancy rates there of 96%, which is very, very high. You know, these folks don't have a lot of property standing empty. And then I would imagine with the work from home and so on, I understand the industrial property should be full, but office space definitely isn't in that much demand, or in my mind it wasn't. But clearly from the occupancy numbers, there is huge demand for office space.
Yeah, Sorrel, that's a good viewpoint as well. I think there has been a clear recovery, and I think there's still further recovery for people coming back to the office, working through there. But I think overall it's still a industry situation where the demand is still a bit suppressed with a bit more supply. So yeah, it does become a bit more competitive as well through there. So, but I do see some further improvements as we go along to the back to office space.
Thank you. Alex has got an interesting question. Alex is saying, are there portfolio of properties not at risk of land expropriation? Now, Alex, I don't know if we know that. You know, it's almost like when my dad had to sell his farms to the government. We didn't know until they came and told us. It's quite difficult to determine what's there for expropriation or considered for redistribution. And I don't think such a list exists. Junior, you can correct me if I'm wrong, but I'm not sure that we know which of their properties are at risk of expropriation.
Agreed. Same.
Okay. Then Swadesh says, how does Redefine compare to the other property companies in relation to their earnings per share and their dividend yield and so on? I know you touched about them compared to the sector, but do you have an idea of how they compare to something like Growthpoint?
Not at the moment now, but I can definitely come back with that to them.
Perfect.
Thank you so much.
Thanks. But I mean, from your earlier graph, they've definitely caught up, and they're performing in line with the sector averages at the moment.
Yes, definitely.
think, Sorrel, sorry to interject there, just to comment a little bit on that as well. So
yeah, Fiso,
when it comes to sort of the EPS growth and comparing Redefine to the other property guys, they're growing a little bit above, let's call it the sector average in terms of their funds from operations per share. There's only a few outliers that grow a little bit higher than that. Namely, let's call it Attack. And one of the reasons being there is, remember, they get a cash injection from the GPF transaction. They're still working that through. They're building a lot of their some of the industrial let's call it developments are coming into the revenue line. But in terms of relative to all the others, as with something like a growth point, they're sort of moving in line. When it comes to dividend yields, that becomes a little bit more of a stock specific question, but typically the property guys actually trade sort of in line. The property guys is where you're going to get closer to the best dividend yield across the, let's call it the investment market, across the Aussie, unless you want to go directly into bonds. So I wouldn't really worry too much about the dividend yield specifically for Redefine. And in terms of earnings growth, we've actually sort of waned out the downward pressure from the interest rates that put that big pressure on the, call it the debt costs. Sort of weighing that out now, and we started to see a lot of positive guidance from all of the property guys. So in terms of the earnings growth, it is in line with most of the sector, with one or two outliers being negative and the other one being quite positive.
Yeah, I know I'm putting you on the spot here, Fiso, but do we know, just for interest's sake, these property companies, what sort of debt to equity ratios do they run?
Debt to equity ratios. No, let me get back to you on that one. But what I can comment on is more on the loan to value ratio. So we know that property is typically a very debt heavy sector. And when it comes to specifically the SA REITs, the average is closer to about, let's call it 40%. So if you're looking at a property stock that's specifically an SA REIT, so not the likes of the Nepi Rock Castles and the Sirius Estates, specifically the SA REITs. If you're seeing something within the range of, let's say, let's call it 38 to about 41%, you're still within a good range. So I wouldn't worry too much about that. I think the other thing is some of these property guys have been well positioned to take advantage of the interest rate cuts. So some of them sort of removed all the hedges on their long-term debt, looking to refinance it at better interest rates. So we'd start to worry a little bit less and less about their debt levels, because at this moment, they sort of worked into reducing that kind of exposure to make their balance sheets look a little bit better. So from an LTV perspective, they're all just about fine. If you're seeing an LTV of between, call it 38% and 41%, you're sort of fine. But when it comes to the debt to equity ratios, I would have to come back to you on that one.
Yeah, Andres, no, it was just something that popped up in my head. No crisis. I mean, you've explained the LTVs and that, so it makes sense. I don't see any further questions. So to summarize, guys, we all think that rates can come down a little bit lower, which would play into the hands of these property companies. We've seen these companies perform well when rates come down. The Junior's analysis has said to us that there's an intrinsic value that's quite a bit higher than where the share price is trading. Sean's technical bit has shown that it could pull back a little bit further, so you could look for slightly lower levels to purchase some and then keep them, for a while to see how the interest rate game pans out over the next year or two, and then so something to be on the lookout for is to wait for a slight pullback and then maybe take a bit of a stab and buy a couple of redefines for the portfolio. Sean, do you know what we're doing next week?
Harmony, I think.
That's right. It's Harmony with Marnus. You're right. Okay, so we'll be back next week, Thursday, talking about Harmony with Marnus. Junior, thank you very much, mate. Well done on your debut. Thanks for informing us. It was a pleasure having you. And guys, thanks for joining us. We'll see you next week when we're talking about Harmony. Have a great Thursday. Cheers.